Alright, what's up everyone? Welcome back to Compound Interesting. This is Emil, and as you can probably tell from my sunburn, I've been away. I was down in the west coast of Ireland in Dingle, so that's why I haven't released a video in about a week or so. So I'm sorry about that, but we're straight back onto it now. So in today's video, I want to present a few of my arguments for why value investing has performed worse than tech or growth investing in the last decade or two. So for example, the likes of Berkshire Hathaway has underperformed the S&P 500 in the last 10 or so years, but also Berkshire Hathaway, Warren Buffett's basically holding company or his hedge fund almost, has underperformed ARK Invest, which is kind of a tech innovation growth index fund, and also the Nasdaq, which is generally more tech heavy. It's a more tech heavy index fund, has outperformed the S&P 500 in the last 10 or 20 years. So I want to present some arguments for why that is and for why I believe that will continue to be so in the future. So before we get going on why tech investing and growth investing is so undervalued right now and has continued to perform amazingly in the last decade or two, just ask that you quickly smash the thumbs up button early. Helps the small channel get off the ground. Make sure to subscribe if you haven't already. I release videos about 3 times a week on investing in the stock market mostly, and also cryptocurrency are my main two topics of interest. So with all that said, maybe hit the notification bell as well, because I'm a really small channel, so it won't appear in your recommended feed unless you hit the notification bell, or it'll actually come into your notifications. So with all that jargon out of the way, let's get cracking straight into the video. So I'll just quickly explain what exactly I mean by value investing. So value investing got very, very popular thanks to Warren Buffett, and hundreds of books have been written about value investing, and hundreds of books about Warren Buffett's style of investing have been written in the last number of decades, and because of that it's become very, very popular. And don't get me wrong, value investing has done amazing for a long time, and I still think value investing has plenty of merit. However, when everyone is kind of going after the same thing, everyone's looking for value stocks, if everyone's doing it, then it's obviously going to be more difficult to find value stocks or real value stocks. But if everyone's just kind of investing randomly, then value stocks might be more easy to find. So here are a couple of examples of when a company is undervalued. So for example, if a company is below its book value, that's generally considered to be potentially an undervalued company. So a company's book value is essentially all its assets and minus all its liabilities. So basically how much the company is worth on paper without like its brand. So like for example, Coca-Cola's, all the factories of Coca-Cola minus like the brand of Coca-Cola, or how much money it'll make in the future. Just basically the actual asset it owns, take away the debt that it owes. So that's essentially what a book value is. Another example that value investors like to really hunt after are stocks that have low price to earnings ratios, price to sales ratios, or even PEG ratios. So generally companies that have really low price to earnings or price to sales ratio might be considered to be good value stocks. And a company could be good value, like it has a cheap price compared to the amount of earnings it's created or the revenue that it's creating, because of a short-term problem. So that's classic value investing. So like oil prices have been hammered recently, but a lot of people think oil prices are bound to rebound and the company's earnings will shoot back up very soon. So that's kind of a classic example of something in the short term that has affected the price of a stock too much, or like investors are getting over exaggerated about the impact of a short-term trouble for a company. So they're selling the stock way too cheap. So someone like Warren Buffett comes along and buys up the stock. Now, obviously everyone wants to buy a stock when it's on sale or it's good value, or when the stock price is, I'd love if Tesla stock shot down 50% for no reason and I could just get it at half price. Everyone wants to do that. But is that definitely the best approach? Or is that ever even going to happen? Like, does Apple or Amazon, like, they very rarely go on sale. The last 2 decades, they're always overvalued on any sort of normal metric. However, if you had bought Amazon or Apple 10 years ago, you'd be doing extremely well right now. So is it the best return? So for example, if a company is trading at 50% of its fair value, okay, I bought the stock for 50% of its fair value, and then in 1 or 2 years the stock doubles and goes back to its fair value and just kind of stays there, then okay, that's great, I got a 2x. That's amazing, really, by most standards. But is that better than potentially a stock that I'm buying now at a fair value? So it's not undervalued, it's not overvalued, it's at a fair value, but its fair value in 10 years time will be 10 times higher than it is now. For me, a long-term investor, option B is much more enticing. If we look at the top 5 biggest companies in America, all 5 of those are tech companies, and out of the top 10 biggest companies in America, 7 are tech companies. So now I want to present some ideas for why I think tech investing has performed so well in the past and will continue to do so in the future. So the first reason why tech investing outperforms value investing or brick and mortar legacy investing is that software is so much easier to scale up and requires so much less capital. Because of this, software companies like Facebook or Google, they can scale up way faster and they don't need as much capital coming in all the time to scale up. So they can grow way faster than like brick and mortar shops. Like, it doesn't take a year for Facebook, if 1 billion more people want to join the Facebook platform, it doesn't take years for them to build out restaurants to facilitate all these people. They can just do it pretty much instantly. So it's so much faster. The growth potential is so much faster, whereas for McDonald's or something, they have to actually go and build all those stores, which might take 6 months or a year or whatever. So the growth can be so much faster if the growth there is required. And also it requires so much less capital coming in. Like, as I said with that example, if McDonald's want to open more shops, that's going to cost a lot of money. So that's going to bring on debt, and it's going to add a load of overheads to the company. So they'll have to pay for lighting, they'll have to pay wages. But if Facebook add 1 billion users, the profit margins are so much higher than the 1 billion more customers that McDonald's would have to take into the restaurants. The overheads for facilitating all those people is so much higher than Facebook. Like, Facebook obviously will have to employ more people, but nowhere near the amount of more people that McDonald's would have to employ. So because of these reasons, software companies just have unprecedented growth and unprecedented profit margins in comparisons to legacy companies. So they can just grow so fast and make so much money so quickly. To add to that, technology companies usually find like a winner takes most scenario much faster than brick and mortar or legacy companies. For example, Amazon quickly established itself as the winner of e-commerce, and will pretty much always be the winner of e-commerce. However, McDonald's has always been dealing with competition. Even though it's the winner, they're probably not taking the most market share out of every fast food restaurant in the world. I don't know what they're probably like 30% of the market share, 10-20% of the market share of large franchise retail fast food restaurants worldwide. But with tech companies, they can quickly become the market leader and dominate their markets. Alright, so enough about the actual companies and how they beat legacy companies in growth and everything. I want to look now at the management styles of tech companies and newer, more disruptive companies. So I'm going to use Amazon as an example. So for Amazon, they were never interested in earning profits. They reinvested everything back into the business to keep growing and keep growing and keep growing. And now they're I think they're the biggest company right now, but they're in the top 3 and they're always fluctuating. But I think Amazon right now are the biggest company in the world, because every single cent they make, they pump back into the business to grow out more warehouses for fulfillment, employ more staff, improve their website, blah, 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 blah. So they're rewarding shareholders in a much different way to legacy companies. They're rewarding shareholders by increasing revenue for Amazon and increasing their market share and their market dominance and increasing their impact on the entire world. And all these factors therefore increase the stock price. So shareholders are rewarded by capital appreciation. However, with legacy companies reward shareholders by paying out dividends, which basically, if a company pays out a dividend, like if I'm collecting the dividend, that's equivalent to me selling. If I'm collecting a 4% dividend, that's equivalent to me selling 4% of my shares every year, because that money has to come from somewhere. if that money had been reinvested into growth, into making the business bigger, that 4% would compound and would earn me much more money in the long term, instead of selling 4% of my shares effectively every year. And legacy companies, they're completely profit driven. They don't care so much about having a big impact on the world or changing the world like Amazon or Tesla. All they care about are profits and earnings. And earnings, like, that's the way value investors think. All they look at is earnings and profits. Now, obviously they're important, but for me, I'm not so interested in earnings in the modern scenario. Earnings are taxed, so that's money that no longer can be rewarded to the shareholders or reinvested into the business. You have to pay taxes on the earnings, and it's money that could have been given to the R&D, research and development department, or for streamlining the businesses. Because right now a lot of legacy companies are cutting costs and cutting R&D just to make the profit line bigger, which helps in the short term but kind of shoots them in the ankle in the long term. So we've established that tech and high growth innovation companies have performed better in the last decade or two over kind of value or legacy companies. And now I want to present some arguments why I think this performance, as I say, this is tech investing and this is value investing. That's what it's done recently. Now I think it's going to diverge even further, and tech and growth companies are going to perform even better again than value investors and value investing in the future. So I think the growth is only accelerating. So if we look at returns over the last 20 years, we can see it averaged about 10%, but over the stock market's entire course of history, it's averaged at about 7%. So for me, this shows me that not only is the stock market growing, but the growth of the stock market is also growing. So there's accelerated growth, and I believe this is mostly due to disruptive tech companies. So I'll just mention that I got a lot of these ideas from ARK Invest's website, the following ideas. So I'll link the research papers in the description if you want to check them out. And I've also done a video on Cathie Wood if you want to check it out as well. But if you don't know what ARK Invest is, go find out. So I believe if you're holding a lot of legacy value companies, a lot of these companies are ripe for disruption. So there's actually, although they're earning a lot of profits, there's also a lot of risk that comes with holding these kind of companies that are ripe for disruption thanks to technology and innovation. So just be very careful that you're not holding companies that are just about on the cusp of being completely disrupted. So maybe we should run through some industries that are ripe for disruption that could potentially be disrupted. All right, so maybe we should run through some industries that I believe are ripe for disruption, and if you're holding some of these companies in these industries, just be wary of potential pitfalls in these industries that could potentially happen. For example, railroads, like trains. If you own a railroad, that could be severely impacted by autonomous electric trucks. So trucks that drive themselves will be just as cheap or cheaper than using trains in the future, because you don't need anyone driving it. It's just a computer on wheels. Electricity is much cheaper, and you're not restricted to where you can go because you don't have to build a railroad to get there. You can use a road. Traditional banking is another area ripe for disruption. So if you hold a lot of banking stocks like Mr. Warren Buffett, unfortunately, there's Square, there's Venmo, they're completely disrupting traditional banks. And let's not even get started on cryptocurrencies that could potentially wipe out 80% of the purposes for traditional banking. Those three, Square, Venmo, blah blah blah, Revolut, cryptocurrencies could completely wipe out traditional banking. Some more examples, like just from AI and robotics, for example, supermarkets might not be needed in the future as everything will be delivered. Artificial intelligence will decide the food that you want. Robots will put it into the autonomous van, and the van will deliver it to your house autonomously. Supermarkets might not be needed in 20 years at all. So ARK Invest believe that there's 5 sectors that are currently worth about $5 trillion in stock market value that will go to an estimated $50 trillion by 2032, so in 10 years. And those 5 sectors are AI, which they believe will make up about a third of this growth. And yeah, AI, huge. DNA sequencing, which will obviously have an enormous effect. I recently put a video about gene editing stock CRISPR if you're interested. It's a pretty good video. Robotics, energy storage, so batteries, and blockchain, cryptocurrencies. So they believe those 5 industries will have bigger impacts than the internet. So they believe robots will be everywhere doing everything we need, and they will all be powered by lithium ion batteries. So from your augmented reality Apple glasses where you can just see your texts and swipe it away through your glasses or whatever, to your flying vehicle, these will all be powered by lithium ion batteries. DNA sequencing is now 1 million times cheaper than it was 15 years ago. So yeah, literally 1 million times cheaper. And every sort of global network will be built on blockchain in the future. So enormous disruption even for the pharmaceutical industry because of DNA sequencing and DNA and gene editing. So just be careful. So they really believe we're on the cusp of an enormous revolution that's on the scale of the Industrial Revolution that happened 100 years ago. So this will be the technological revolution of 2030, let's say. So they believe this is going to completely trounce the impact of computers, of the internet, etc., of the steam engine. These 5 sectors they believe will have a way bigger impact. And some of the applications of these technologies we don't even know yet, and those unintended or unexpected applications sometimes or usually turn out to be the ones which have the biggest impact and which become the most lucrative in the long term. So maybe some people are still scarred from the dot-com bubble in 2000, where any sort of tech stock got extremely overpriced and crashed so significantly. But for me, I know where I'll be investing the majority of my money over the next 5 years, and 5 to 10 years, or probably the rest of my life. I think technology is going to continue to bring the most rewards to shareholders for the very long term if you're a long-term investor. So if you enjoyed my analysis and my thoughts on this topic, please subscribe so you can catch up and continue with my thought processes. And if you enjoyed it, make sure you smash the thumbs up button. It would mean the absolute world to me. I really hope you enjoyed the video. I hope you got some value out of it. If you want to expand your knowledge and you want to support the channel, I have my favorite books linked in the description from Amazon, and it's their affiliate link. So if you want to support the channel, it's the same price for the books. And you want to expand your knowledge, check some of them out if you're interested in that. Once again, really hope you enjoyed the video. Thank you so much for stopping by again. Can't wait to bring you out the next video and see you there. So cheers, thank you, bye.